everyone. Thank you for joining us today. I'm Lizette Gabriel, and I work as a librarian in the Business and Economics Department here at the Los Angeles Public Library. Welcome to today's presentation called Buying a Home. This program is brought to you by the Alliance for Economic Inclusion and the Office of Civics and Community Services here at LAPL. Today's presenters are Mary Salinas Duran, Cheryl Ryman, and Erica Therese. They will go over the process involved in buying a home, including information on loans, mortgages, making an offer, and closing on a home. Please send us your questions throughout the program, and we will have a Q&A session after the presentation. I'd now like to pass the presentation over to Mary.
Thank you, Lisette, and I'd like to thank the Los Angeles Public Library for hosting today's event. The Alliance for Economic Inclusion is very appreciative of this particular opportunity. Presenting to me, as Lisette mentioned, is Cheryl Ryman and Erica Torres Kirkjian. Next. First of all, I'd like to share a disclaimer that this presentation represents the views of the speaker and not necessarily those of the agencies they represent. This presentation cannot be reproduced or distributed by a third party or on a third party website without prior authorization. Next. So what are we trying to do today? Well, we're trying to provide you information on how to get ready to own a home, finalize the purchase, and move forward with buying a home. So you're going to learn about the steps in the home buying process, how to know if you're ready to buy a home, estimating how much you can actually afford, different home financing options, key costs, how to get pre-qualified or pre-approved for a mortgage, and how to compare loan estimates, the role of professionals who can help you become a homeowner, and the process of making an offer, negotiating with the seller, and closing the purchases. And once you have your home, we want to make sure you keep it. And so we'll include a little bit of information on what to do if you're having trouble with mortgage payments. And with that, I would like to turn it over to Erica. Erica, next.
Thank you, Mary. So getting ready to own your own home. We're excited to be here today to present this workshop. We will discuss how to get ready to buy a home and how to figure out what you can afford, especially these times where there might be a lot of people are interested in buying a home. So first of all, we have steps to buying a home. Decide if you are ready to buy a home. You can always reevaluate this decision later on in the process. Next, please. Next. So the first step, you get ready. You decide if you are ready to buy a home. You can always reevaluate this decision later on in the process. So figure out how much you can afford. It will save you time and trouble down the road to have a good sense of what price range you want to focus on in your search for a home. Check your credit history. This is extremely important. Lenders use your credit history to determine whether they will lend you money so you can buy a home and how much the loan will cost you. So you can go to annualcreditreport.com and to request a copy of your credit report at no cost to you. Once a year, you can get your free annual credit report and annualcreditreport.com on the website. You can also review your credit reports before purchasing. We highly recommend it. That website is only place where you can get the free and credit reports from the 3 nationwide credit reporting agencies that you are entitled to under the law every 12 months. Checking your own credit reports do not affect your credit. Step 2. Figured out the financing. So learn about mortgages or other financing options. Shop around. Get pre-qualified or pre-approved, and then we will talk about the difference between the two terms. Next, please. So on step 3, shop for your home. Put together your team. Identify and consult the professionals that can help you search for finance and purchase a home. Then you find a home that fits your needs and that you can afford. On step 4, buy your home. Make an offer on the home you find that meets your needs and that you can afford. Negotiate with the seller, then consider getting a home inspection. Finally, you will close. This completes the process of buying your home. It's when you become its owner. On step 5, you maintain your home. You worked hard to get it, so protect your investment. While not discussed in this module, home maintenance helps you home keep its value and reduces the risk of costly repairs. Next, please. A big question here, how much can you afford? So when it comes to if it's affordable for you, only you can make that decision. However, you can use advice or guidelines to help you decide what may be affordable. We are going to talk about 2 different ways to estimate what you may be able to afford. So your spending and savings plan. So figuring it out what you have left for a housing cost after you pay for everything else. Then you have your debt to income ratio. Figuring it out how much of your income would go to covering your monthly debt payments. This includes the monthly payment for a home loan. Next, please. Now, a mortgage payment is a mortgage is a home loan, okay? So you pay back the loan with monthly mortgage payments. Your monthly mortgage payments are probably going to be the biggest part of your housing cost. When you buy a home, your monthly mortgage payment generally has 4 parts, commonly referred to as a PIT shown on the screen. So the P stands for principal. It's the amount of money you borrow. The interest is the interest on your principal. The taxes is the real estate taxes. The I stands for insurance, and homeowner is the homeowner's insurance. Next, please. Then we have the debt to income ratio. The debt to income ratio is another tool you can use to estimate whether you can afford to borrow the money you need to buy a home. Your debt to income ratio is a calculation. The formula for the debt to income ratio is total monthly debt payments divided by your monthly gross income. The debt to income ratio is often written as a percentage. It shows how much of your monthly gross income, your income before taxes or other deductions are taken out. Goes to covering your monthly debt payments. So your monthly debt payments include your payments on any credit card balances you may have, your payments on other loans you may have, such as car loans or personal loans, and perhaps student loans, and your anticipated monthly housing payment. When lenders look at your debt to income ratio, they may have their own way of calculating it. So for example, some lenders treat student loans different from other loans. You can ask a lender how they calculate the ratio. So if your debt to income ratio is 40%, that means 60% of your gross income is available to cover everything else. So different lenders set different limits for acceptable debts to income ratio. Some lenders prefer debt to income ratios of 36% or less. Other lenders will accept up to 43%, depending on your credit score and other factors. So that's why it's important to work on your credit score. Some may even accept higher debt to income ratios. For most households, keeping their debt to income ratio lower rather than higher provides more stability and security. The debt to income ratio shows how much of your gross income goes towards debt, but you still have other options. Next, please. On this page, we have calculating the debt to income ratio. We have an example of how to calculate the debt to income ratio. So you have your total monthly debt payments. This is an example. And then you have your monthly gross income. And then you have the debt to income ratio calculated. So possible answers here. So what does the debt to income ratio tell you on this example, right? So a few possible answers. More than half of the income is covered debt. The individual may want to look at lower housing costs or ways to eliminate other debt. So many lenders would not loan money to someone with a debt to income ratio this high. So this is where you kind of want to start calculating your debt to income ratio and see where you're at and what changes you need to make. So next, please. So always select the less expensive house, make a larger down payment, and borrow less money, which would reduce the monthly mortgage payment. You can always ask a family member to help with the down payment, right? See if there's a federal, state, or community programs to help people with down payments and closing costs. Increase income, you may ask for a raise or take another job. So the key takeaway here, remember, buying a home is a process. Start by making sure you're ready to buy and figure out what you can afford. So now I'm going to turn it to my colleague Cheryl Ryman.
Well, good morning, good afternoon, everyone. Thank you for joining us again. So on the next slide, you'll see that in this section, we're going to talk about the different types of loans, define some loan terms and concepts, describe how mortgages work, and how to shop around for a mortgage. So on the next slide, please. Oh, one more. I'm sorry. Thank you. So as Erica just mentioned, there's different parts to a mortgage. So the mortgage itself is the loan. The principal is the amount of money that you borrow to buy your home. And some of the costs. The costs can involve many things. It could include the interest, which is the cost of using the money that you borrow expressed as a percentage. Points. Some lenders may offer you the option to buy down your rate via points. And that will result in a lower interest rate over the life of the loan, but it means that you pay more money up front. And points may be a good choice for people who know that they will keep the loan for a long time. Fees. Fees can include lender charges for processing your application. They may have different names, such as application fee or processing fee or underwriting fees. And then there may be other charges, such as an appraisal fee, so that the borrower knows that the property has value to back up their loan. And then the lenders will express an annual percentage rate. And this is the key term. When you're shopping around for mortgages, the APR is really what you're looking for, because that gives you the overall cost of the loan on an annual basis. Next slide, please. Of course, the down payment. Now, the down payment is the biggie, right? That seems to be, I think, the biggest obstacle to getting into home ownership. The down payment is a portion of the home's price that you pay in cash up front. For example, if you wanted to buy a home for $160,000 and had $8,000 down for a down payment, you would then borrow $152,000, right? The difference between the cost of the home minus your down payment. That would be a 5% down payment, right? Needless to say, the higher your down payment, the less money you have to borrow. Next, please. So private mortgage insurance, PMI. When your down payment is less than 20% of the purchase price, lenders may require that you purchase PMI. So it is possible. It is absolutely possible to buy a home with less than 20% down, but it will cost you. Private mortgage insurance is different than your homeowner's insurance. Homeowner's insurance pays for losses and damages to your property if something unexpected happens, like a fire or burglary. Well, PMI lowers the risk to the lender of a residential real estate loan to you, similar to gap insurance for vehicles. But PMI does increase your monthly payments. So the lower your down payment is, as it relates to the purchase price of the home, the more likely you will have to pay PMI. And the terms of your loan will specify how long you must pay the PMI. Some loans require that you pay PMI until a certain percentage of your loan is paid off, like that 80-20%. And other loans may specify a period or require it for the life of the loan. Next slide, please. So as we discussed earlier with your mortgage, there's a lot of costs to having a mortgage, including taxes and insurance. So we talked about principal, interest, now taxes, insurance. We talked about NPITI, so principal, interest, taxes, and insurance. So there are two common ways that you can pay for your taxes and your insurance, on your homeowner's insurance. So part of that can be it can be escrowed as part of your mortgage payment, or you pay them outside of the mortgage on your own. Sometimes your lender may give you the choice of paying taxes on your own or having them escrowed into your mortgage payment. But more often than not, mortgage lenders will require the interest or the mortgage taxes and insurance to be escrowed. Now, this is not to be confused with the process of being in escrow for a home, right? This is separate. This goes into your mortgage payment. Even if you're not required to have your taxes and insurance escrowed, oftentimes it's just easier to do that so that you don't have to worry about making those payments when they're due. And you can pay little by little by little rather than having that lump sum payment. And your property taxes and insurance premiums can change from year to year. So your escrow payment, and with it, your total monthly payment could also change. Although those are not generally significant increases, but bear that in mind. Next slide, please. So fixed rate mortgage. A fixed rate mortgage is one in which the interest rate does not change. So once you sign those loan docs and you're locked in at a 2.75 rate of interest for 30 years, then that's it. For 30 years, your loan amount doesn't change. Now, remember, your taxes and your insurance can change, but your loan mortgage principal amount and your rate does not change. So you pay the same amount every month in principal and interest for the life of the loan, right? So that's fixed. But remember, interest and taxes can change. So the term of a fixed rate mortgage is often 15 to 30 years, although there may be some other term lengths that are available. This kind of mortgage is really good, especially in today's environment when the rates are low, or if you plan to keep the mortgage for a long time. Next slide, please. Next up is adjustable rate mortgages. So with an adjustable rate mortgage or an ARM, your mortgage may start with a lower rate of interest than compared to fixed rate mortgages. But your interest rate and therefore your monthly payments will change. They could go up, and sometimes by quite a lot. The rate adjusts on a predetermined date, or it's tied to an index. For example, it could be every year, every 3 years, or 5 years, or 7 years, if it's tied to the dates. And then if it's tied to an index is a common standard of interest. So if we're talking about Fed Prime +2, right? So that's a variable. And this is often expressed in numbers, excuse me, such as an ARM, a 3-1 ARM. A 3-1 is the 3 stands for the number of years that the interest rate will stay at the same number, And the 1 means that the interest rate could change every year after the first 3 years. A 3.2 means that the interest rate stays the same for 3 years, and then it can change every 2 years. So an ARM may be a good choice if you plan to keep the mortgage for just a short time, right? It may not be a good choice if you cannot afford to pay more if the interest rates do go up. So bear in mind that if you're shopping for a home, an ARM might be appealing now because it has the low introductory rate. But bear in mind that once that expires, your rate can go up. And so your house payment, your mortgage payment would go up. If you're considering an adjustable rate mortgage, please be sure to carefully review. There's a document that the lender is required to provide to you. It's a consumer handbook on adjustable rate mortgages. You can also Google it and look at it online. But make sure that you understand what you're getting into when you get into an adjustable rate mortgage, because it is difficult to gauge what's going to happen in the future. I mean, we know that we're looking at low rates right now, but in 3 years or 5 years, you just don't know. On the next slide, please. Now a conventional mortgage. So mortgages can be classified as either conventional or government guaranteed, which is also called government insured. So conventional mortgages do not have any special requirements for borrowers, such as having served in the military or living in a rural community. They're available to anyone, but they may be a little bit more difficult for some people to qualify for than other types of mortgages. You generally need a good credit history, right? If you're thinking about buying a home, the first thing to do is to look at your credit reports. And Erica gave the website earlier, www.annualcreditreport.com. It's really important that you look at your credit. It plays a huge role on whether you can even qualify. And if you do qualify, how much you might pay in interest rates. The higher your credit score, the lower your interest rate will be. They also, lenders consider your income, your regular source of income, right? And as Erica mentioned earlier, also your debt to income ratio. It must be within the lender's acceptable limits. And the traditional rule of thumb was 36%, although there are exceptions to that, and some lenders will approve loans for people with higher debt to income ratios, although you might pay a higher rate of interest. And then, of course, the down payment. So the down payment, which can range from 3% to 20% or more, depending on the lender, depending on the loan program, and depending on how much money you have available to use as a down payment. Okay, next slide, please. So government guaranteed loans. So we talked about conventional loans. Now we'll talk about the government guaranteed loans. So there are a lot of options here. It includes the FHA, USDA, VA, and HUD loans. So the FHA, the U.S. Federal Housing Administration, helps people become homeowners. With an FHA loan, the lender may be able to offer you better terms than with a conventional loan, including a low down payment, as low as 3.5% of the purchase price. So instead of having to come up with 20%, 3.5%. And then the closing costs may be included in the loan amount. So when you're going through the home buying process, there are costs, including closing costs in booking the mortgage. Well, oftentimes those are paid out of pocket, but with an FHA loan, those can be rolled into the loan amount. Okay. FHA loans may be easier to qualify for, although there is a maximum loan amount, which varies by area, right? Housing costs in California are different than housing costs in Texas. So there are different limits based by region. Then there's also the USDA. The U.S. Department of Agriculture also has home buying programs similar to FHA, and those are generally for more rural areas. Then, of course, the VA, the U.S. Department of Veterans Affairs, they have a home loan program, which is wonderful. right? These loans are only available to qualified borrowers, members of the military. VA loans do not require a down payment, although you can certainly choose to make one. Let's see. Oh, I think I skipped up on my own notes. With VA loans, they also do not have mortgage insurance requirements, although there is an upfront funding fee, but that fee varies. It's based on a number of different factors, including type of military service, down payment, if you have any, disability status, whether you're buying or refinancing a home, and whether this is your first home loan or not. So definitely keep in mind that there are options for different types of loan programs. Okay, next slide, please. So other assistance. There are a number of programs that are available to help with particularly low and moderate people getting into homes. And that comes in the form of a number of different programs. It may include down payment assistance or closing cost assistance. First-time home buyer programs that offer down payment assistance have special loans or other forms of assistance to get people buying a home for the first time or for the first time in 3 or 5 years. Programs to help people in specific professions to get homes in the communities where they work. For example, HUD's Good Neighbor Next Door program offers homes at discounted prices for law enforcement officers, teachers, firefighters, and emergency care workers. So when you're considering looking for a home, it's really important that you shop around for the mortgage and for different programs that may be available. Next slide, please. Then amortization, the hard word for me to say. So when we amming out the loan, when we amortize your loan, the amount you pay each month is calculated, right, to ensure that you pay a portion of both your principal and your interest each month. So that helps to calculate your payment being the same each and every month, except for when your interest rate changes with an adjustable rate mortgage. So the amortization schedule, you receive it when you sign your loan docs, right? And they have to give you an estimate even before then. And it shows how much of each monthly payment throughout the life of the loan, how much is being applied to the principal and how much is being applied to the interest. And early in the life of the loan, the majority of your payment is going to go to interest, right? So you're not going to see much of a principal reduction early in the loan unless you do additional payments, principal reduction that will go directly to reducing the principal. Okay. And it's nice because if you can do anything, even if you just round up to the nearest $10, the next $10, shaving off that little bit of principal each and every month, the extra principal reduction will have a significant impact over the life of the loan. Next slide, please. Now, getting pre-qualified or pre-approved. This is really important when you're ready to actually start talking to real estate agents. Pre-qualification is an informal way to get an estimate, realistically, a realistic estimate of how much money you could borrow, what you can afford. You can be pre-qualified by giving a lender some basic information over the phone. No paperwork is required. There's no obligation. The pre-qualified amount is not exact. It's only an estimate, and it is not an approval for a loan. But it gives you that check. You know, if you're thinking that you can afford a $500,000 mortgage and you go through the pre-qualification process and they come back and say, well, $450,000. Well, you have to readjust your expectations when you're actually shopping for a home now. A pre-approval is an actual commitment. So you've been through the qualification process. You've gone through and you've you know how much you can buy, right? And the sellers know that you're now ready to buy that home. They don't have to wait for you to get approved for your loan because you're already approved. To get a pre-approval, you need to assemble financial records and fill out the application. You're going to need documents like pay stubs for the last 2 or 3 months. You need W-2 forms for the last 2 years, tax returns, information about your assets and your debts. Remember, debt to income ratio, like Erica spoke about, recent bank statements, and if you have any additional information, you need proof of that. Now, you do not need to disclose alimony or child support payments unless you want the lender to consider them as income to support the loan repayment. So getting pre-approval is a really great step in the process. Next, please. So now that you know about the basics of mortgages, you can shop around. Now, this is really important, but almost half of all people who get mortgages don't really shop for their mortgages. They just go wherever it's easy. Maybe somebody told them to go somewhere. But shopping for a mortgage can save you money over the life of the loan. Get loan estimates from several different lenders. A loan estimate is a document that provides important information about a loan, including the APR and any other fees or costs that may be associated. So your real estate agent might suggest a specific lender, but get written estimates from at least 2 others, just so you know. Ask other real estate professionals, friends, colleagues, family members for recommendations. If you have a relationship with a financial institution, don't forget to get an estimate from them also. So contact the lenders that you're considering and tell them that you're ready to request a loan estimate. You don't need to provide written documentation yet. You generally just need to provide 6 key pieces of information, right? Your name, your income, your social security number so that the lender can check your credit, the address of the home that you plan to purchase, an estimate of the home's value, typically the sale price, and the amount that you want to borrow. So the amount of the sale price less your down payment. Now, there is no other fee for a loan estimate, although they might charge a fee for pulling your credit report. Okay. And make sure that you ask questions to understand the information that they're providing you. Next, please. So, know your loan. Learn about financing options for buying a home and shop around to get the best deal for you. All right? Thank you. And now I will turn it back over to Erica.
Thank you, Cheryl. So in this section, we will discuss how to put together a team of professionals to help you buy a home. The major steps to buying a home and where to get help if you find you're struggling to make payments on your home. So putting together your team and finding a home. There are many professionals who can help and guide you in the home buying process. One such professional is a real estate agent. They can help you find a home that meets your needs and wants. So who else might play a role in helping you buy a home? I'm going to mention a few of them, and so that you have an idea. So we have the appraiser, we have a lender, we also have housing inspector, and then we have attorneys in some states. We have title insurance agents, and then we have insurance agents as well. We have escrow officers, and most importantly, a housing counselor. I think that, one of the, that we will give you a few websites that you can visit and find a HUD-approved housing counselor who can help you, will provide you with education and counseling and the home buying process. So, in addition of today's workshop, you can learn more and they can help you through that process. Next, please. Making an offer on a home can be both complicated, exciting, and frightening at the same time, right? Once you find a house that you want to buy, you will make an offer. This is when you tell the seller, I want to buy your home, and this is how much I am going to pay. Your real estate agent or attorney will write your offer. Next, please. So what is an offer? Your offer to the seller will generally include the following items: the address and description of the property, the sales price, how much money you're offering to pay, your targeted date for closing. But one very important point here is the amount of earnest money deposit you will be putting down. So this is a deposit you would put down, but remember this, in case you cancel, you can lose your deposit. So we often say that try to offer as low as possible and talk to your agent and let them know about this, because you can lose that deposit if you were to not move along with the purchase. Next, please. I'm sorry, we stay there. So what else is in an offer, right? So the description of who pays for things like title insurance, termite inspections, and property surveys. A walkthrough clause stating that you have the right to walk through the property one more time before the sale is finalized. So this is generally preferable after the seller has moved out and right before closing. The date you offer expires. If the seller wishes to accept your offer, they must do so before this date. There's also contingencies. So these are statements that you must be true or the other offer is void. It must be true, the other offer will be void, right? So this could include you getting financing and results of the inspection. Then we also have a special request. So for example, the buyer could request that all appliances be included in the home purchase. Now, other terms required by the laws in your state or your real estate agent think are important to include in the offer. So it's always good to have good communication with your real estate agent to help you through this process. Next, please. So now you made an offer. Here's what happened. The seller accepts your offer and negotiations end. So your offer plus the seller's acceptance become a legally binding sales contract. Then the seller rejects your offer and makes a counteroffer back to you. You can walk away from the transaction. There's no legally binding contract. You can, at this point, you can accept or reject that counteroffer. You could also make a counteroffer to that counteroffer. Now, and the other one could be the seller rejects your offer and does not make a counteroffer back to you. So in this case, you can walk away from the transaction. There's no legally binding contract. Or you could present a new offer to the seller and the process starts all over again. So as you can see, this can become complicated pretty quickly, right? That's why it's important to have professionals help you through the process. If the seller accepts your offer or you accept a counter offer from the seller, you will move forward with the financing and the closing process. Next, please. Now, home inspection. Consider including a requirement in your offer that says it depends on results from home inspection. It can save you a lot of headaches. It can save you from purchasing a house that may be defective, right? So this is a type of contingency. This means your offer is contingent or depends on getting the results from the home inspection and you deciding at that point if you still want to purchase that home. The home inspection will give you detailed information about the condition of the home before you buy it. So this is one of the most important steps in protecting you and your investment in the home buying process. This is because significant issues with the property may not be apparent with the home inspection. While you can get recommendations from a home inspector from your real estate agent, make sure you are getting someone who will put your interest first, not those of the real estate agent. In a home inspection, a qualified inspector takes an in-depth, unbiased look at your potential new home. So if you have to evaluate the physical, they have to evaluate the physical condition, structure, construction, and mechanical systems. They identify items that need to be repaired or replaced, estimate the remaining useful life of the major systems, such as equipment, structure, and finishes. In some cases, you may need a secondary inspection. So, for example, if the property you wish to purchase has an unusual heating and cooling system, or it has well water, you may need to have those items inspected separately if there could be foundation issues. So you may need to consult a structural engineer. In markets where homes are selling very quickly, some buyers may decide to waive a home inspection, but we really don't recommend that. They may be willing to take the risk of buying a house that has a potential unknown amount of needed repair work so that their offer is more attractive to the seller. So it is really ultimately your decision whether to require a home inspection as a contingency to your offer. Either way, you should know your rights and what you're giving up if you choose not to get one. Next, please. So documents at closing. You can expect to get the following documents at closing. The loan estimate. So this lays out information about your loan. You will have already seen this document in more circumstances. We have the closing disclosures. This is the form that lists the final terms of the loan, final closing costs, and the details of your pays and who pays and receives the money at closing. Your lender must send this document to you at least 3 business days before the closing. Initial escrow statements. So this lists the cost that the lender expects to pay from your escrow account. So this includes estimated taxes, insurance premiums, and other charges during the first year of your loan. So if there will not be an escrow account, as we talked about earlier, there isn't always an escrow account. This statement will be blank, right? So then we have the promissory note. This is a document that details your loan. It includes the following: the amount of money you borrow and must pay back, the interest rate on the mortgage loan, the dates when you must make the payments on the loan, the term or length of the loan, the total amount of money you will pay over the term of the loan. So whether and how the payment amounts can change. Cheryl mentioned to you about different types of loans, so it's very important to read this promissory note. So where you must send the payments, final. So also you have the payment option information. You may receive information on how to arrange for your mortgage payments to be automatically deducted from a bank account, which we highly recommend it. You don't have to write a check every month to your mortgage. You have mortgage security instrument. This document explains your rights and responsibility as a borrower. The mortgage grants the lender or servicer the right to foreclose on your home if you fail to make payments as you have agreed. So you will not receive a notice to right to rescind, because once the loan closes, you do not have the right to cancel it. However, you will receive this notice if you are refinancing a mortgage under certain circumstances. There may be other documents required by state or local law Your lender may give you additional documents. So always, again, check back with your lender. Next, please. So closing is the last step in the home buying process. This is where you work hard to get this home, and now you're about to close. So at closing, the loan becomes final. Funds are distributed to the seller and other professionals who receive the payment at closing. This is also when you will become the owner of the home. The title to a property gives you the right to use and sell the property. The deed or deed of trust is the actual legal document that transfers the title to you and is recorded with the county government. Next, please. Now we're getting you already have your house, things happen, and some people go through, hardships happen. So getting help when you're in trouble. I think it's always good to discuss that there's, help, right? It is important to get help if you are unavailable to make your mortgage payments. So this could be the result of a one-time issue. For example, you could have a large unexpected expense that use up your money for a month or two, or it could be a long-term issue. For example, you or someone else in your household loses a job, or your hours are cut at your job. As soon as you anticipate trouble making your mortgage payment, please get help. The number one mistake most people make is waiting too long to get help. So we have different ways to get help. You can contact your lender directly. You can contact the Home Preservation Hotline, and we will give you that information before the end of the workshop. You can contact HUD-approved housing council and agencies. You can contact your state finance agency. So please know that there's help out there. You just have to speak when you have that. Let's hope that nobody gets to that problem, but just in case, we never know. Accidents happen, COVID happened, and no one was expecting it. Next, please. So remember the takeaway from this last section. Get help with the home buying process. It's very important that you get connected with professionals. Interview before you hired help and ask for references. Please know that you can choose your team to help you to a successful home ownership. Understand what services you will receive and how much they will cost you. And again, shop around. Good luck with the home buying process. I'm going to turn it to Mary Salinas for to end the presentation. Thank you.
Thank you, Erica, and thank you, Cheryl. Next slide. They've provided you with great information. The whole home buying process can be overwhelming, but one of the important things is to take some action. What are you going to do with the information you learned today? How are you going to go about doing it? And are you going to share it with someone? Sharing the information with someone is like when you decide you're going on a diet and you just think about it. You may not be as successful as if you told your best friend and they help you, keeping on your diet. So what are you going to do first? Next slide. So one of the things that I wanted to share with you is another initiative of the Alliance for Economic Inclusion, which is called Los Angeles Saves. And I want to encourage you to take a pledge to save for your down payment because you're going to need money to buy your home. Next. The pledge is very easy. There's 4 steps to it. You go online to lasaves.org. It asks for your name. It asks for what your goal is. And there's a number of goals, but I thought the most appropriate for today's workshop would be home ownership. And then you make a plan. The amount you want to save per month and the number of months. So maybe you want to start off by saving $100 a month, or maybe you have more than that you want to save. And how many months are you going to do it? So you put those two calculations, those two numbers into the pledge. That's making your plan. And the fourth step is you provide an email address and your zip code, no address, just your zip code, and you can sign up to receive text messages, tips, and advice. And if you do this, and we encourage you to sign up for the text messages, you won't get more than 2 a month. And I personally have found them very helpful as I work on saving for my own goals. So please consider taking lasaves.org, the pledge, a pledge to yourself. No financial information is provided in it other than you provide an email and zip code. There's no marketing that goes out from this other than a newsletter and tips if you sign up for text messaging. Next. Now, these are the resources that we wanted to share with you. When I said, what steps are you going to take? One of your first steps might be to pull your own credit report and see what it looks like. And as a result of the current pandemic, you are actually able to pull a credit report each week from each of the 3 agencies. Generally speaking, you get to pick one free report a year from each of the 3 agencies. And this is where you can get them free, www.annualcreditreport.com. If you're looking for a HUD-approved counseling service, and we strongly suggest that you go through a more intensive training. They offer an 8-hour program. Many of it's virtual, but they actually have one-to-one counseling to assist you. And this is where you can find them from HUD. Erica talked about home preservation, and there's a 24 hours a day phone line as well as website that you can reach out to. Once you buy a home and you fall into trouble, or maybe you have friends and they're having a challenge with making their mortgage payments, this is where you can reach out to. And it's a hotline, no cost, because it's from a nonprofit agency. The Consumer Finance Protection Bureau has a great website, has a lot of information and Q&As related to mortgages. I wanted to remind you to take the LA Saves Pledge, and I'm assuming that you have a bank account. But if you don't, getting a bank account should be one of your first steps in the process to purchasing a home. And the FDIC has a website that provides you with information on how to shop for a bank account if you don't already have one. Next. So we want to thank you, and we appreciate the opportunity, really appreciate the Los Angeles Public Library hosting today's event, and we're open to some questions, and I'll turn it back over to our host. You're on mute.
Oh, my bad. Sorry about that. So thank you again. And there have been a few questions during the presentation. So the first question was, if someone wishes to buy a home, what might be their first steps?
Credit. Pull your credit report. Take a look at your credit. And if you have any questions about it, definitely get assistance from a certified credit counselor like Erica had mentioned. But credit is so important, whether or not you can qualify for a loan, and then how much you will pay for that loan over the life of the loan.
Great. Okay. Let's see for the second one. How can a home loan counselor help me through the process?
Housing counselor can help you. All the steps that we talked about, they're there to help you prepare from the beginning, from working on your credit, for helping you address your review your credit with you. And if you have any credit problems, they can help you with that. They can also help you with the pre-purchase, understanding how much money, how much house you can afford. We said it in the workshop, that you have to make sure that you understand and you're comfortable with the house that you're going to buy, how much you can afford, and be very realistic. That some things that, although we may want a bigger house, but can we really afford that? So back to the housing counselor, they would walk with you and they would tell you how much house you can afford. And they have, there's no cost. They're HUD-approved housing counselors that can help you at no cost. And you can be ready in 2 months, 6 months, in a year, 6 years. And they would just basically walk you through the process.
All right, sounds good. Okay, so a few more. How much does PMI cost?
Well, the cost of PMI, so this is the private mortgage insurance. So if you come in to a home loan with less than 20% down and you have to have PMI, there's a number of different factors that affect the cost of PMI. One is how much of a down payment do you have? The lower your down payment, the more your PMI will cost, right? Because you've got to make up that gap. And also it will depend on the type of loan, whether it's a conventional loan, FHA, if it is a VA loan, are you paying PMI or MIP? So there's a number of different things, but at least a couple of $100,000. So it will depend on how much of a down payment you have, 3% up to the 20%, and how much mortgage. If you have a $200,000 mortgage as opposed to an $800,000 mortgage. So there's a lot of things that are factored in for PMI costs.
Oh, wow, that's always a good one, PMI. Okay, so let's see towards the end here. How will taking the LA Safes pledge help me in the home buying process?
Well, it'll serve to be a constant reminder of you to make a pledge to yourself to save each month for your down payment. In today's market, the cost of a house has certainly escalated. And to the extent that you can have a bigger down payment, the cost of the loan will be less over the life of your loan because you'll be having to borrow less money. So we strongly encourage, take the LA Safes pledge. It's voluntary. Nobody's going to know but you, and you'll get some reminders to keep on focused on saving.
Okay. Okay, so it looks like we have a few more questions, but I do want to remind the viewers that are here with us today that the video will be available to you through the LAPL's YouTube channel. So if you didn't get a chance to see the first part or towards the end, again, the video will be available to you at LAPL's YouTube channel. So I see that there are a few other questions, and let me see if I can sort of quickly skim through them. All right. So here's one. How do I calculate what my monthly payments will be on a specific loan? Anyone up for grabs?
Well, there are a number of calculators that are available online. I myself, not to advocate, but I like NerdWallet because it contains a lot of information about a lot of different things. But you can Google mortgage calculator and come up with, a number of different options. Just be careful about the sites that you go to, because sometimes they will trigger, they'll ask for your contact information and then you'll start getting, spam. But there are calculators that are available. And also too, don't hesitate to talk to a lender. If you can just ask them for general information for that loan estimate.
Okay.
And we always recommend that, because you have a relationship this is why it's very important to, have a relationship with the bank, a banking institution that you already have a checking account, savings account. You can always go directly to them for help at no cost to you. That's part of the services that they provide to you. So they're you rest assured that you can trust your bank to help you with talking about homeownership.
All right.
Lizette, I was just going to add that the basic three things you need is how much money you're going to borrow, what's the interest rate, and for how many years. So you need those three elements to be able to put into the calculator to determine that. Obviously, later on, when you have to pay real estate taxes and property insurance on your property, those are going to be additional costs. But you can start off with just how much you want to borrow, what you think the interest rate is, and for how many years. And that will give you a general idea.
Okay, sounds good. There was another question as to, a credit report. So will it affect my credit score if I shop around for loans?
I'll take that one.
Yeah.
I'll take that one. Great question. So as you're obviously are aware that inquiries on your credit report can affect your credit score. Generally speaking, though, if you have multiple inquiries from either automobile lenders, student loan lenders, or mortgage lenders within the same general timeline, and generally that's like within 30 days, depending on what module they're using, even though it shows multiple inquiries on your credit report, it will only affect your score as if it were one inquiry. So it will affect your score, but even if there are 15 inquiries from mortgage lenders within 30 days, only one will affect your credit score.
Okay. So the good takeaway for this is do it all within the month.
Yes.
Okay.
Within the 30 days. Yes.
Good to know. All right.
Yes.
So lastly, we have sort of a comment question here. I'm 54 years old and would be a first-time home buyer. My feelings would not be hurt in the least, but am I and my husband too mature to even consider buying a home? Perhaps a condo is best. So.
Not at all. Not at all. So when you're looking to buy a home, you're looking for that stability. So no, you're not too mature to look into buying a home. The financial stability of owning your own home and the wealth building for family, for succession, you're never too late for that. Now, whether or not you want to buy a single family home as opposed to a condo where they take care of the yard work is an entirely different ballgame. But those are things that you really need to talk to your real estate agent or maybe even your HUD certified housing counselor about.
And this is a great point of someone that's a great question. And it's a very understandable question that when, like Cheryl says, you speak with your housing counselor, and remember we talked about, can you afford this home? So I think, again, if you're able to afford this home, and then if your ratios, we talk about ratios, how much you can debt to income ratio, if they don't if you are not going to live to make this payment, then maybe you are right to buy in a home at any age if you have the funds. So I would again say the housing council will be a best person to come and help you with this. They'll become your best friends to help you through the whole process.
Perfect. Good to know. All right. So I don't see any more questions that are popping up. So I will take that as sort of the end of our presentation. So again, if you guys have any questions, please reach out to us. The information for the resources is on the presentation. And again, the video will be up on LAPL's YouTube channel. So please go ahead and look at it again, review it, screenshot anything that you might think is important for you. And again, reach out to, as our presenter said, to the home counselors, to your bank, look around, and keep in mind those credit reports within the month. Okay, so again, take away as much as you can from this presentation. Thank you again to all of you for being with us today. Thank you to the presenters, Mary, Erica, and Cheryl. Really appreciate it. And again, all of you, it's lunchtime, so have a great afternoon.
Thank you, Lizette.
All right, thank you, everyone.
Take care.
Bye.